to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jason Bottenfield, partner wealth manager with Park Cities Group at Steward Partners, to discuss active versus passive investing, but not in the investment profession, rather through the lens of the financial planning profession. Jason, it's great to have you with us. Welcome to Trade Talks.
Yeah, thanks for having me, Jill. Appreciate it.
Why should one be active with their advisor?
Yeah, I think, right now, with the markets on the relative highs that they're on, the widespread inflation, parlayed with some legislative changes that are coming from the current administration and the Build Better Act right now. I've been in the business for nearly 20 years, and I don't think that I've seen this many things happening at the same time at the transition of a year. Usually we may have something with the taxes, or we're thinking about the market, but we have also these big legislative changes that are going to be happening in my profession, which is the financial planning profession as a certified financial planner. And you parlay all that together, and I think there's just a lot on everyone's minds. But in particular, I don't think that these are things that you can kind of get just kind of doing it by yourself. So, reaching out and talking with your tax accountant, talking with your estate attorney, talking with a certified financial planner, and just trying to figure out what these changes are actually going to do for individuals that are investing at multitudes of levels, not just ultra high net worth or high net worth, but even young accumulators. There's a lot of things that I think are missed. And there's just a lot going on right now that I've seen with my career and what's going to transition here, that I just think I want to raise the red flag and say, hey, have someone help you take a look at what's going on, or at least take a look at what strategy you have in place.
Explain to us why you think Roth strategies are under attack in 2022.
Yeah, so kind of a broad statement that they're under attack, but it really is true. I mean, there's the Roth account in general is something that was created to get people to invest early on. It had some income restrictions on it, and then in 2010 there were some real legislative changes that happened, and it allowed for kind of higher income earners to go into these strategies and convert into these strategies. So a lot of different tax mitigation strategies were created through that legislation in 2010. And the Build Back Better Act, the BBB bill, is traveling through Congress right now. I think even today the House passed it, and it needs to move on. So I don't know if that happens before the end of the year. But in that legislation, they've added in to remove these strategies for high income earners to be able to fund Roth IRAs. Then they took it out, they put it in. So I don't know what's going to actually, exist in the bill as it comes through. But the attack on the Roth strategies is really that there's a couple of different ways that people have been using these. And there's a mega backdoor Roth strategy, which some may not be familiar with. It's not widely used, but a lot of people do use it, where you fund a 401k plan with after-tax contributions and then convert it to a Roth IRA. So it's a way to get around the income restrictions. But more broadly, since 2010, a lot of investors, young and retired, have been, not retired, but up to retirement, have been using the backdoor Roth IRA strategy, to where, a lot of people I talk to almost every month, prospective clients and things of that nature, that they say, look, I can't fund a Roth IRA because of my income. Well, that hasn't really been true since 2010. There's a few different caveats you have to look at, but they're looking to close the ability for you to fund an IRA and then convert it over to a Roth, effectively getting around some of the income restrictions. Because if you make over $180,000, $190,000, you're not really allowed to directly fund to a Roth IRA if you're a married family. So a lot of these strategies are just coming up to play, but they're very unique, and I see them as great opportunities for younger investors. Unfortunately, a lot of younger investors haven't been taking advantage of it since 2010, but unfortunately it's going to be too late, because I think what's going to be in this bill is that they're going to remove that for 2022. And then kind of a broader sweeping change that I think is going to affect a lot more people is just Roth conversions in general. And so what that is that if you had pre-tax assets inside of a 401k, or just roll them to an IRA, a lot of people would convert those to a Roth. And, you remove some of the restrictions of having to make distributions at 72, required distributions.
Right,
and
Jason, 30 seconds here. I want to move on to inflation.
Okay. And so the opportunity on these Roth strategies is just going to be closed in 2022. And I think that you really need to look at funding those now, or look at what your strategies are moving forward.
Let's talk about inflation, because it might not change your client behavior on the balance, but there are some ways to play these increases and hedge the impact. How so?
Yeah, so I think inflation has just been very rampant right now, and some of the issues and the client behaviors I don't think are changing for our clients as far as inflation. But I think where a lot of people start to think about inflation and assets to go into, some people think of gold, and because markets are high, they may be looking at that as well. But I see the energy market as it's pulled back a little bit this month. I see that as an opportunity to have dividends coming into play where gold doesn't have that. I think our thesis would change a little bit if we do see another crisis or something like that, where a fear trade comes in and maybe gold is a better asset for some inflation. And there's other areas to invest in, but we're really focusing on, if we have clients that are saying, look, maybe I should get into gold, we're really kind of positioning them over to the energy market, just because I think the demand's still there.
All right. And I want to wrap up here with the types of companies that you're leaning towards as we continue to face supply chain constraints, which of course is part of that inflation conversation.
Yeah, the supply chain situation right here is pretty unique. I had an opportunity to see it firsthand with a company made a toy car of one of my cars, and it was set off the coast for a month. So I'm not an expert in supply chain, but I really think that if you go into companies that are a little bit more, that have digital services, I think the tech play is going to continue to move on and to continue to grow. And I think if you're in those companies that provide services or don't have those supply transmission lines that are getting affected here, or if you could find some that have the tangible goods that manufacture in the US, I think there's some opportunities there as well. But we're really looking at that tech area, that fourth industrial revolution, where it's the digitalization of the economy. And really, if you don't have to move it through trucks and you just goes over the Wi-Fi network, I think there's some real opportunity to continue there.
All right, Jason, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.